We are live. We should be broadcasting across multiple platforms. You should all be able to see and hear me. I hope the audio works. Please don't blame me if it doesn't. It is simply because of Google and all of those things. So I hope you're all there. Apologies, just 3 or 4 minutes late. So thank you very much. And you should be able to see me as well, I hope. I am going to turn on my screen share. So you should be able to see my screen in just a second. And we're also going to be doing this live on TikTok, would you believe, as well. So let me know you can see and hear me, and let me know where you're from as well. The talk went very well this morning indeed. Okay, so let me share the screen. Like I said, I hope everybody can hear me on both channels. I'm not sure if that's even possible, but fingers crossed that you all can. Now, let me know if this is also your first time on here as well. I am about to share the screen, he says rather optimistically. Here we go. And you should be able to see my screen as well at the same time. Okay, so thank you as well. And let's go with where we are on all of this. I want to start off, because it's the first of the month, I want to start off with what I might call the 10 commandments of investing. Then we'll talk about the markets as well. Okay, so the first things first, the reason I want to talk about these is each month I go through these. Now I'm going to go through every single one. You can take these as you wish. Let us get into this one. I think we're roughly around here. Thou shalt invest in portfolios, not prophecies. Yes, the markets are overbought. Yes, so many stocks look expensive on a valuation basis, but valuation is not what moves markets alone. Other things matter as well. Yes, statistically, we're due for at least a 10% correction, if not 20% statistically, historically, but history does not guarantee the future. The best thing to do at these times is not necessarily to be out of the market, though I have no skin in the game in the sense that, listen, I'm not a stockbroker, I am not a retail fund manager, I'm not an IFA, I'm not a wealth manager. Whether you invest or not makes no odds to me. But I think now is the more appropriate time, while the markets are still rising, but they're overbought, to be thinking about portfolios, not individual stocks. The mistake private investors consistently make is they think purely in terms of, I've got to pick this, got this hot tip, got this hot newsletter tip. And then they say, this one worked, that one didn't. It's like gambling in Vegas, as opposed to looking at their portfolios as a whole. And I want you to think of this. En route to becoming the world's richest man, Warren Buffett, Ravi, this is live. Why? Is there something sort of not working out? The en route to becoming the world's richest man, what had happened is that he never had a single year where every single stock went up. He never had a single year where he picked the best performing stock in the stock market. And that's en route to becoming the world's richest man. And I think this is incredibly important, that you think of your portfolio as a whole and not simply in terms of, have I got the right breathless investment? That can be quite dangerous if you do that that way. Okay? So that's the first point I wanted to make. Now, you can take a note of all the others. I don't want to go through all of them. The other thing I like to do at times like this, when people are worried about the market being overbought somewhat, and I share this with my clients. Let me move myself so I'm a lot smaller, so I don't keep interrupting you all with where I am. There we go. That should make it a bit more better for you. Is this little flowchart. Now, you can take a picture. I'm not going to go through this at the moment. Am I risk averse? No. I'll tell you exactly where I'm at the moment. On a scale where risk loving means you buy anything and everything you get your hands on, to risk averse where you're out of the markets completely, I'm at the stage where, if let's say I wanted to buy £10,000 worth of any company, whatever the company is, and we'll go through some companies in a second, I would be inclined to put, say, 3,000 this month, 3,000 a month after, 3,000 a month after that, rather than going all in. Now, that makes decision making a lot easier, but because of the nature of the market and my own personal risk appetite. Notice what I said, my own personal risk appetite. Okay. That is critical and important for me. Also, as well as, by the way, for everyone letting me know where they are, good, you can hear me. Good. Let me know if it is your first time on here. Oh, did I say first of the month? No, sorry, the first webinar of the month. It's the first webinar of the month. It's the 2nd of October. Now, the other thing I get asked the most, and I want you to keep a note of this, and you can again take a photo of this, is what should I do, Alpesh? Should I buy this stock? Should I hold on to this company? What people are getting wrong there is they think there's a crystal ball. They think, oh, you must know more than everybody else or whatever else. It is far more sensible to have the same process for all your investments. And it's regret minimization. Now, that actually comes from the work of Daniel Kahneman, Eugene Fama, and Richard Thaler. Thaler and Kahneman in particular, because they were psychologists who won the Nobel Prize in economics, were particularly useful on the investment side because they weren't looking at what's the fundamentals, what's the return on investment, what's the capital growth. What they were looking at is, well, actually, if we don't know what the future is going to hold, we don't know what to do, why don't we mitigate and minimize our risk, our regret? Okay, so again, you can take a picture of that if you wish. Sorry if it's not clear on the screen as well. Okay, now there's more I want to get through. Okay, before we get into the stocks and where we are with the market, and I'm going to go through the stock market news in a second. Again, I'm asked by people, what should I do? This all comes down to what should I do? And they think I'm going to say to them, hey, go buy AppLovin because some high beta stock newsletter said it, or go shove it into, some tiny little penny stock, and hopefully when you roll the dice, you'll make money. What? Short of insider information, I'd be gambling if I said that anyway, and it's not what I do. What I say is, let's look at the whole portfolio, make sure that overall as a team, we're going to make good money and good returns without too many drawdowns. Where am I at the moment, therefore? I personally am around here. You might be more risk averse. You might be down here. You can see the drawbacks of each of these approaches. Print it out, put it on your desk. That is going to teach you more about risk and risk management than thinking what you think you know, which is, oh, you're just supposed to throw darts at a dartboard and hopefully some newsletter somewhere and somebody will tell me a rumor at the pub and that's what makes you rich. If you think that's how professional fund managers got rich, by going to the pub and listening to the newsletters, you are absolutely wrong on that. Okay. Instead, it was to determine where they sit on this risk appetite. The other aspect is there's only 3 things the markets you can enter. There's only 3 times you're ever going to enter: prematurely, perfectly on time, or late. Now, I don't think I can ever get it perfectly on time because you're talking about being a microcosm in, right? Entering prematurely seems to be making a hash of things, because what usually happens is, for no good reason, you've pulled the trigger early. Why? Why would you do that? What are you afraid of? Okay. I, like most hedge fund managers, if you look at Winton Capital, I suggest you research them, prefer being a little bit late, because the odds statistically, I found, are more in my favor. The market has already started doing what I want it to do. Why private clients do the other 2 things is down to psychology. They try and think they've got to be absolutely perfectly timed, or they think they've got to be early, which inevitably means that they get a lot of gambling and they lose a lot of money and they panic as well. I'm going to come to US stock market shutdown. We've got, because I'm also live on TikTok, a bunch of questions that are coming through there, so I'm going to answer those as well in a moment. Now, we need to have a market-based action plan, and you can, again, see it on screen right over there, okay? I'm over here for those who can't see me if you want to see me. Now, you can take a picture of this. Where are we at the moment? Market stage. It doesn't take me to tell you that. Why people want to jump, if they know they're at this stage, why they want to prematurely jump into one of these action points is completely irrational. At the moment, it's a case of holding and compounding. You're letting your profits run. Long-term gains come from patience. That's it. That's where we are. Now, should these other stages hold, I will let you know. But again, I'll be late. because I like confirmation. Maybe it's my barrister's training. I like corroborative evidence on something. That's why I will be late. I won't ever be early, and I certainly won't be on time. In fact, pretty much in real life as well with meetings. I'll probably be late, I'm afraid. Okay, now, the other thing I want you to remember, because this is going to happen, okay, you're going to have either path A, path B, or path C. Retail clients lose money because they take path A with their investing. Buy, stock drops, they panic sell, market recovers, they miss the gains, they get a permanent loss. You've got two other options, and these are always superior. If you know anything about game theory, for instance, in economics, these are what you might call superior strategies. Okay, first one, you buy, the stock drops, you might hold because you know it's a quality company. If it's not a quality company, you shouldn't have bought it anyway. Market recovers, you have a long-term gain. Or path C, you buy, the stock drops, you sell, but rationally as an insurance policy against further sells. And if the stock recovers, you know the insurance cost is you might have to buy back more expensive later. You've controlled your risk. That's it. What do retail clients do? They mess it up. What they do is they do path A, always path A. They've got three options. They enter prematurely, and then they run by emotion. All you have to do is B and C. It's that simple. It really is. Okay. And retail clients are just, they're nuts. Now, I'm going to give you a bit of the politics stuff before we go into the individual stocks and what's going on with the markets. The way I want to do it is actually not with the things that are on there. I've put my credentials at the top in terms of just my background. I used to be on the council at Chatham House and 300 shows on Bloomberg TV and all the rest of it. So I try and use my politics background and economics background into just talking about the market. So let's talk about what's in the news then, Alpesh. Okay, my number one source of news is Bloomberg. It is the best financial source of news in the world. And in a world where there's few reliable sources of information, this is one of the best. Now, tech drives stock rally as OpenAI fuels optimism. That is sentiment. That is momentum. I don't need to prematurely exit my tech stocks. My 2Ms and 3As, what I call my quality 5, which I've mentioned many times publicly before, Meta, Microsoft, Apple, Amazon, Alphabet. I don't need to prematurely exit those. Thinking, oh, well, Apple's never going to invent anything ever again. Actually, I think they are. I think they're going to invent the glasses. I've got 2 pairs of Meta glasses. If Apple invests glasses, I'm going to grow new eyes just so I can wear more of those, because the glasses is freaking amazing in so many ways. Okay. Jacob, I like that comment. Thank you. So on the tech momentum side, all these people panicking, oh my God. Well, if you've got good quality companies, and everything I say, and we're going to look at quality companies, is predicated on good quality companies. If you want to gamble, and oh my God, retail clients don't even realize they're gambling. That's why there's a Ladbrokes on every single high street in Britain, because the average person is a ridiculous gambler. Okay, I'm not. Now, I don't mind that it's not valuation driving stocks, arguably. It is momentum. Momentum is what most hedge fund managers base their businesses on anyway. Something goes up because the trends continue. It's a hell of a lot easier investing on momentum than it is on fundamentals, narrative, news, charts, technicals, moving averages, anything else. Momentum is a hell of a lot easier. So if you look at something like a Winton Capital or AHL, some of the biggest funds in the world, they will have a momentum on. Renaissance Capital, DE Shaw, because it's a hell of a lot easier to make money just following momentum. So the fact that it's momentum only seems to scare retail clients and not us. So that doesn't bother me. Now, oil sliding is really good. OPEC boosting supplies is good news for stocks. Why? Because it reduces costs for companies and costs for consumers. There's only 3 sources of spending in the economy. Government spending, okay, well, that's going to come out of taxes, and they're already in the West debt-ridden, so it's not going to be that great. Consumption by consumers, i.e. you and me, well, we can't do it if we're spending everything on fuel and heating, right? If mortgage rates go down, we'll have a bit more money, but if taxes go up, we'll have less money. And investment. So CIG, consumption, consumers, investment, businesses. If interest rates go down, businesses have to pay less to banks and therefore they'll have more money to invest. Great. And employ more people and so on, or government. Well, I don't think we're going to rely on government spending at the moment in most Western economies, certainly not in the US. They're claiming that they need to cut back. I mean, they've got a shutdown. So oil prices going down is good. Okay, that is good. Chip makers add $200 billion to global rally on AI frenzy. Whether you think AI is a bubble or not, personally, it might be for some small, tiny little companies who are using AI after every single thing. I mean, everybody says, oh, just like these, I'm a crypto company. What are you now? Oh, I'm an AI company. You know, there was a time when floated companies, tiny little penny stocks, which I don't invest in anymore, I did as a student, would just add the title crypto or Bitcoin because they knew that some nutty retail client is going to put money into them. Not me, okay? But that is good news for my holdings. What can I say? This game is stupidly simple. That's why people mess it up. I don't have to do anything. It is the only business in the world, the business of investing, where less work and doing less makes you more money. That's why retail clients mess it up, and men mess it up more than women. And the academic research proves it. When I wrote the books, and by the way, if you'd like a free copy of that, alpeshpatel.com/links, okay? You can go there for that book. So let's look at a few other things. Well, Ghana's not important. Sorry. France isn't important. Okay. France is detaining oil tankers. Now, this is good news for us in the markets, because if the second row of headlines are irrelevant, New African Ratings Agents, doesn't matter. Headquartered in Mauritius, who gives a shit? Okay. What that means is if your second set of headlines are irrelevant because they deal with France, Africa, Ghana, then you're laughing. It means the market will continue going in the direction it's going in, which at the moment is upwards. Berkshire to buy Occidental's chemical unit. Well, they already own Occidental. I'll show you what Berkshire owns in a second. Intel up 7%. Remember, we're looking at the stock itself. Is it a quality company? Too risky for my liking. I've written a note which I shared on my public Telegram channel, which I'll show you in a second. Can Intel go up 100% in a year? I said, yeah, but you're going to have a bumpy ride. Not for me. Same with Tesla. Tesla, not for me. I don't like the bumps. Do I think it's going to double within 5 years, if not sooner? Yeah, absolutely. I think Tesla will double within 5 years, if not sooner, but I don't want the ride along the way, which is why all my money is not in Bitcoin, because I know Bitcoin will probably double in the next 5 years, but it'll give me a 75% fall at some point. So thank you. I've got a small amount. That's all I want. That's the best way to look at it. If you go even further than that, great. Chinese crypto fraudster pleads guilty to laundering $7 billion. It's not going to affect the markets. Now it's really getting into, there really is no news, which is market relevant. That is good news. What the retail client does is look at that and go, oh my God, what can I buy? What can I punt on? Okay, it's like they call them punters. There isn't. It's a case of keeping with what you've got. Gold. Investors can't seem to get enough of gold. My wife, as you all know, I've said it a million times, bought some gold coins in December. I wish she bought a bucket load more now, in hindsight, but I didn't have a time machine. I asked her, do you want to buy more? And she said, no, I think that'll do. I think she's a gold expert in that regard. She bought a little, not too much, doesn't want to buy more. There you go. Job done. Move on. Stop trying to get it exactly perfectly right and thinking, oh God, should I put all my money in red or on black? No, don't put all your money in anything. That's why you don't put all your money in just one egg. Right, there's nothing else happening over there. So that's the news taken care of. I want to show you the Telegram channel in case you've not been looking at it. alpeshpatel.com/links, the Telegram channel. Now, what I want to show you, don't forget, I've got my daily updates, but what I actually want to show you on this, and I've written about stable coins and bank tokens if you're into that kind of really niche stuff. There's a podcast, there's an article, also City Group research on there. That's not what I want to show you. Retirement income dilemmas. That's on there. We've got our tools. We've done some working out and calculations for people where we were asked on the blog, okay, how much can I withdraw? Should I buy an annuity? Okay. So what we did is we worked it out and we've got some free online tools for you. This is then a calculation which we've given people and shown them how to do it as well. Okay, because people don't know what to do when they retire. So we've got a load of stuff there for you. I'm going to get rid of that one as well. Now, something else I want to show you is this. The image, the new Magnificent Seven. These have been mentioned in the news. Okay, who's going to take the crown from NVIDIA, Apple, Microsoft, Meta, Alphabet, Tesla, Amazon? Okay, so that was the Magnificent Seven. Now, if you know me, you will know it's not a secret. The two M's and the three A's, Meta, Microsoft, Apple, Amazon, Alphabet, and NVIDIA I own. Tesla, I don't. Yes, I have S&P 500. My son and wife have 2 times leverage ETF in S&P 500 and 3 times leverage in that as well. Why? Well, because I hold it for them. The next issue is this, the new Magnificent Seven. So for those who don't know where this article is, I'm not sure I can post this actually. It's on the blog, which is, again, the blog you will find alpeshpatel.com/links. Okay. Now, of those, yes, I happen to have Broadcom. Palantir, the IPO meant we didn't have enough data to get into it. Wish I had. I mean, look at it. But we don't tend to do IPOs, neither does Warren Buffett. Okay. Oracle, only part of a model portfolio, not in and of itself, because again, it's been quite volatile historically, and the market's fallen in love with it after a very long time. So it's interesting that for us, I would only look at that as part of a model portfolio. This is all on the free Telegram channel, by the way. Okay. This is where we are. Global stocks rally for 3rd year. Next year, I don't think it's going to go up again, but I'm not worried about next year because I don't worry about what I don't need to worry about before I need to worry about it. Okay. So that's where we are with that one. Now, I want to show you something else. We did some analysis on some of the most popular funds that people have invested in, like Aegon, LifePath, Flex. We've got a whole bunch of these. We've got a whole bunch on here. If you look at all these popular funds, we've done an article on virtually every single one we can get our hands on. Fundsmith, Scottish Widow, St. James's Place, HSBC, Fundsmith again, St. James's Place again. My God, they come up a lot. Okay, and a whole bunch. If you want to see that on the blog, it's all free. All the analysis is there. What was scary was when we did the analysis, the gap on any of those fund managers, and it's the same for all of them, in any given year might look like a couple of percentage points. When you compounded that over, say, 20 years, it meant that somebody starting with 100,000 was left after 20 years with, say, 400,000, and they missed out on 1.2 million. Okay. They ended up with 400K. There you go. That's what it would have got you, continuing along the performance it's done. Just the Miski world. I mean, not, follow Alpesh. No, nothing like that. Just an exchange traded fund on the global world index. That's it, just the world, which is one of the safer, lower growth ones, actually. That's the difference in retirement over that time frame. And it's shocking how often this happens. So I've put that on my Telegram. It's on the blog as well. I want to draw that to your attention because I think people are missing a lot of the good stuff as well on that. Okay. I also want to show you this. Foreign holdings of US equities have hit records. For all those people who keep saying to me, isn't the US overbought? Well, again, since the Second World War, I think people have been saying that. Isn't it overbought? Isn't it overbought? The fact of the matter is they have all the money and they suck all the oxygen out of the air and get all the talent, and they have a monopoly in some of the biggest companies. So they steal all the talent. You're not going to compete with Amazon. If you're going to set up a firm here, they're going to undercut you because they can take a loss longer than you can. And you're going to go out of business. They're going to run you out of business. Okay. So yeah, I tend to be US focused because that makes me global focused. It's all on the Telegram, HSBC Global Developed Index. Guess what? You're paying for it. Now you might think, well, if I go for the HSBC Global Developed Index in my pension or wherever, oops, lost it. Okay, you might think, oh no, I'm doing fine, Alpesh. I'm doing fine. I can do that. Well, no, because if it continues compounding the rate it's been compared just to an exchange trade fund like the Miski World, then after 20 years, your 100K, instead of being, again, 1.15 million, which is what the global index would be, because I just told you it would be, you're left with just 352K with HSBC. And yet they will give it a lovely title, Global Developed Index Fund 3. Because the first two were bad enough, but we had to make another sequel in the series. Fundsmith, 5% per annum for the last 5 years. 5% per annum. They live off a brand. Okay, so be worried. All of this is free. All of this is free. I've been very lucky with client reviews as well. All right. So I just wanted to show you some of this stuff. Fundsmith, Masterclass Mediocrity. And we don't just say that. We really break it down. So for those of you who are here because you're looking at funds, I'm going to go to the markets in a second, but because you're looking at funds, all right, we really break it down. Right? It's 5.8%. Just so you know, we show you the formulas, how we worked out their returns, what it's been. That's what they generate. That's Fundsmith. They're not as good as they like to think they are. And the reason for that is, first of all, well, we broke it down actually. What the reason for is they missed the US rallies. They just insist on investing in bloody L'Oreal. I don't know what it is. Is Terry Smith just on the makeup or something? It is ridiculous. So all this completely free if you want to see it all. Okay. So anyway, I just thought I'd make sure that you're all familiar with that as well. The other thing I want to get across to you guys is this. You know, US, the point I was making earlier, the US, this is from Goldman Sachs. The US invests a lot more in research and development. It's why their companies stay ahead. It's why their companies make more money. Plus, you've got more choice with their companies anyway. Europe invests less. It tends to grow less. Those that invest more make more money. They also make more profits. When I was doing my Bloomberg show during the dot-com bubble, I said, keep an eye on profits. The few companies that make profits are the safer bet. Okay, because profits we all care about. That's what puts food on the table. Okay. Patel says, wait, you're that guy that did... No, that's another brown person. I did the Financial Times competition, which I won. I'm not that guy who did the Sunday Times one. Though it's very easy. All brown people look the same, so I'm sure you're thinking of Jersh Manek. I'm Alpesh Patel. Close, but no cigar. He doesn't have a beard. I do. In fact, the only thing he and I have in common is, well, I just already told you, we're brown. Now, biggest falling giants. You've got a whole load of other stuff. Now, let's get back into the markets. I'm going to leave that one for now. Okay. What I want to show you, so that's the Telegram channel. What I want to show you next is I want to go back to the markets. And here we are. Now, I've done this in my books previously. I've shared it with my clients as well. This was done last April. And it holds. And the reason I've not I'm going to show you the update in a second. It's last April. Okay, so you just need to go down there. And you go there. Okay, as well. All right, now, where are we at the moment? I'm going to show you in a second. Markets move in cycles. 1, 2, 3, 4, 5, 6, 7. Right? These are the numbers. You can write this down. Where are we at the moment? We're still at number 1, believe it or not. We're still at number 1. What is number 1? Number 1 is this. Risk-loving will buy 70% chance of a 10% drop in 6 months. How do I know that? How do you know the future, Alpesh? Because we're at number 1. It always bloody happens when you're at number 1. What's number 1? It's when the short and medium time prices are moving. By the way, if you want to do this yourself, TrendSpider or TradingView or Google Finance or Yahoo Finance, this is just a simple monthly MACD. Well, Alpesh, it's not 100% right, and it doesn't get me right in at the top and at the bottom. No, what you're looking for is a time machine. Don't have that. Okay, this is close enough for you. Trust me, you'll be fine. You'll be fine with this one. Now, this is it. I've got some clients who said, I'm going to print this out. I said, well, you know what? It's in my books. Similar, almost identical. Okay. I've done about 18 of those books. You can download it for free. alpeshpatel.com/links. We're at number 1. We will get to number 2. We're not there yet. I don't prematurely exit on the basis that, I must be early or I must get the timing exactly correct. When we're at 2, I'll tell you when we're at 2. Where are we? This is where we are. Where are we? We're still at number 1. How can you tell, Alpesh? Well, I can tell because there, look, still rising. Pattern recognition looks similar to this. Are we falling yet? No. Are we about to fall? Probably. Is it happening now? No. Is it happening at 2:33 on a sunny, bikini weather afternoon in London? No. So relax. Go enjoy the sun. Put your mankini on. Stop panicking and I must exit because in the future at some point things might fall. Yeah, well, we'll deal with it in the future. Don't have to do it right now. Honestly, if you're lazy, this is the best profession in the world. Warren Buffett says that because he likes investing because he can be lazy. Me as well. It's where we are. Pattern recognition, just look at it. Is it guaranteed? No, if you want guarantees, move away from the computer screen. You're insane. You could hurt yourself. Okay? So that's that. I'm going to show you something amazing in a second. Now, these, they look worrying, don't they? Because there's a lot of red there. Shall I tell you what they are? You are paying $28 for every future dollar of profit in Microsoft. If you buy Microsoft, you're paying $28 for every future dollar of profit in Microsoft. Is that a lot? Is that little? What does it matter? Does that mean the stock price is going to fall or rise? Well, think of it like this. You buy a house called Microsoft, and your rental income is $1 in profits a year, okay? But you pay $28 for it. Now, there's another house down the road called Goldman Sachs. For Goldman Sachs, for those of you who know me, and I've said it publicly many times before, I own Goldman Sachs and JP Morgan. Now, Goldman Sachs is $14 you're paying for every future dollar of profit. You might say, well, bloody hell, I'll pay half as much. NVIDIA, that's $29 I've got to pay. If I buy a share in NVIDIA, for each dollar of profit they make. For Goldman Sachs, I only have to pay half of that. And in the last 12 months, by the way, Goldman Sachs has gone up. My Goldman Sachs holding has gone up more than my NVIDIA holding in the last 12 months. Okay, but valuation is not the only thing which moves prices. That's just coincidence that Goldman Sachs happens to be half as valued and has performed better. Twice as better? No, not twice as better, but better. The point I'm making is valuation is the only factor. So every time you go, oh, the market looks a bit overvalued, mate. Well, valuation isn't the only thing that moves stocks. Growth does, for instance. That's why some of these companies are more expensive. You can formulate an opinion, if you wish, on limited facts. I'm sure you will. People do it every day on social media. But I'm not going to read into that. Therefore, this is going to collapse or Palantir's necessarily overvalued. Other than relative to Microsoft, you're paying more for its future profits, but its growth and its momentum might mean you still make more money as an investor. Because an investor makes money. It's really simple. Now watch this. This is really top secret what I'm about to tell you. Okay, I mean the president would have me assassinated for what I'm going to tell you. An investor makes money from selling at a higher price than what they paid for something. I know, earth-shattering, isn't it? That's it. Everything else, what's its valuation? What about this? What about that? What about this? Honestly, you and I don't have a PhD. Don't worry about it. What I'm saying is, yeah, it is more expensive on a valuation basis than Microsoft, but those are not the only things that can move prices. Micron is cheap. Doesn't mean you would go all in on that compared to Broadcom. Am I happy with my Apple holding? Yeah, I'm very happy. And my Amazon holding. I don't want Tesla. Well, it's not to do with the valuation. I just don't want the volatility. God knows before he goes and does something, says something stupid. I don't know. I know they're doing very well. I have no doubt they will at least double in the next 5 years, as I said, but I just don't want the roller coaster ride. For instance, my son always wants you to go on roller coasters. I say, son, I know we're going to have a lot of fun on those, but let's just stick to Crazy Caterpillar because that's about daddy's sort of, gut can take. That looks cheap, but valuation is not the only thing. JP Morgan looks cheap. Okay, I want to show you something. So Goldman Sachs, the irony of ironies as a shareholder, I was with the CEO of Goldman Sachs International. There we go. Bloody handsome fellow that he is, annoyingly. There he is. Okay, that's the Colonel Shah, CEO of Goldman Sachs International. And that's Sanjoy, my old friend, who's chairman of Goldman Sachs India. I said to Colonel, you guys, me being a shareholder in Goldman's, you've made me more money in the last 12 months than NVIDIA. And most people wouldn't believe that. They think, bank? More than NVIDIA? I mean, I know it's only 1 year. Don't read too much into it just being... By the way, my LinkedIn is free. You can follow me on there. I'm what they call a top voice, would you believe? Here we go. And there's a ton of articles that I write on there. But it's free. So you're more than welcome to follow me on there should you wish to do so. Right? Now, we're going to dive into some of the companies. By the way, these are earnings which are coming out on Monday, Exxon, McCormick, and the like. None of these are going to move the markets. I don't even think Exxon's going to move the markets. Okay. ExxonMobil, not likely to move the markets. Mobile came around, for those who know their economic history, because there was a time when America, in its hatred for imperial powers, think King George III, had antitrust legislation where they would break up big companies. So Standard Oil, massive monopoly, like today's Amazon or Google or Alphabet or whatever. And they broke it up, which is why the company SO, Standard Oil, exists. They broke it up into smaller pieces. They don't do that anymore. Now they've become fully imperial. They've totally assimilated into sort of imperial way of doing things, which means, hey, don't complain about it. That's why I own Meta, Microsoft, Apple, Amazon, Alphabet. They're absolute monopolies. Drives the EU mental. Another benefit. Now, where are we on the S&P? Is it a bubble? Well, let's look at the bubbles. So this is the S&P 500, which is 500 stocks, which is truly, actually, because it's market cap weighted. In other words, the index of 500 stocks is based upon the size, the market capitalization, how big, how much you pay for these companies. And the bigger the bubble, the more it's weighting on the index. So it's really an index of about 7 companies, of which I own a bundle. So that, and that. Well, is it a bubble? Well, Amazon's not there. And this is the 0% mark. Well, if it's a bubble, you'd think there'd be more companies above 0%, wouldn't you? So is it a bubble? Well, what's that one? I don't know what these are. They're a bit small. I tend not to do small if I can avoid it because the volatility tends to be mental. Are there any sectors completely leading the way? Well, real estate's lagging. Does that mean it's going to accelerate? Well, there's a hypothesis you might want to test. When you come up with an idea with investing, it's your hard-earned money. Don't just roll the dice and think, well, I'll punt on that, sweetheart. Let's put it this way. Let's say you're a man, for argument's sake. Think how you're going to explain it to your wife. Well, sweetheart, I have no idea. I was sure, little lady, energy was lagging. Not many companies were going up. So I thought I'd put the children's future on energy stocks. They might catch up. No. Think instead, well, there's an hypothesis and I've tested it. If you're not going to do it that way with your own money, hey, look, it's your money. But I certainly would treat it with more respect than private investors tend to do. So what is lagging? Consumer staples are. Does that mean they're going to catch up? I'm not so sure. Does it mean information technology should be the only one we're in? Well, no, because actually I'd probably say numerically as many companies are up or as are down. There are just as many companies in the information technology sector in S&P 500 which are down so far this year. In fact, I'd probably say more companies are down. There's a bear market. Look, companies are falling. There's more below the 0% mark than above it. So why is the S&P 500 at all-time highs? Because it's market cap weighted, and if you're not in those 7 companies, which is why the fund managers, there's hedge funds shutting down because they won't take that level of concentrated risk. I'll show you Warren Buffett's portfolio. Here we go. Okay. And what I mean about concentrated risk. By the way, this is not controversial. It's from Goldman Sachs Wealth Management. It's what they base their advice on their wealthiest clients to, depending on your retirement age, equity allocation. Now, my wife says I've got 25 years to retirement, so I have about 90% in equities at the moment. This is also from them, or it might be JP Morgan. It's one of those two. There we go. Now, this is not secret because they have to tell people. It's not as if I snuck into their office and secretly stole all this. But one of the things that's important, if you look at the Goldman Sachs holdings, Apple, Nvidia, ETF, S&P, Microsoft, Amazon, Alphabet, Meta, Broadcom, and then the rest are, again, S&Ps. Look at Warren Buffett and Bill Gates. After their first 5 holdings, they've got less than 5% in anything else. So, yeah, they've got a concentrated holding. If anything, you might say between Bill Gates, Warren Buffett, and Goldman Sachs, they're the buggers who are actually making all this money in the S&P. Your fund manager will not have the level of concentration that the billionaires have. Now, I don't know how you're going to become a billionaire if you don't copy the billionaires. That's between you and your IFA. My point being, like Buffett said, I have no problems putting all the eggs in one basket as long as I am watching the basket. Best platform to buy equities? I don't know. have a look at Free Trade, Hargreaves Lansdown, AJ Bell, Interactive Investor, Interactive Broker. Those are the names that come up the most. Much of a muchness. Just that's what I'd say. There you go. Just trial and error them. See what you like the look of. So this is what the past week is. That's noise. That's noise. Don't get overexcited going, oh, I've got a theory. Private investors have this urge to create theories. They'll go, oh, well, Oracle's down. That's going to be a great company. I think I'll buy it on the dip and the bounce. Have you got any evidence for why you should do that? I mean, if you're punting and gambling, fine. But you'll make a lot more money if you go to Ladbrokes and say, I think it's going to be up next week. Can you give me some odds on that, mate? I'm not recommending you do that, by the way. Okay? So this is just noise. 1 week, here or there. If you want to trade, that's different. I'll guarantee you in a year you'll lose money, because if you're untrained and you trade, I guarantee you one thing, you will lose money trading. We're talking investing, which is buying and holding. Past year makes it a hell of a lot easier, doesn't it? Which of these two would you prefer? A market that looks like this, remember red is bad and maroon is bad, green is good, or this? Which do you think is going to make you more money? This or this? This or this? Well, obviously the year. It's a hell of a lot easier. So there you go. Microsoft's up 20% in the past year. Only 20%. I'm somewhat surprised. I thought it'd be up more. I'm really surprised Apple's only up 11. I thought it'd be up more. I was gobsmacked that Goldman Sachs, my holding there is up 60%, and JP Morgan, I'm up 50%. I actually thought my Nvidia holding would be up more. Yeah? That's why I don't just buy one stock. Because if I was that good, I would have known to just... Okay, and the best news is there are enough darts that they get a few that they can use in marketing which went up, and they can ignore the ones which went down. So be careful. Now, Intel, I've written about it, volatile. Qualcomm, I don't mind it as part of a portfolio, but never look at it by itself, because by itself, it's going to have up and down years. Now, is Apple due for a resurgence? Yeah, I'd probably say it's due for a resurgence. Hope you can all hear me. I think there might be an internet problem. There often is. We've got really fast Virgin Business broadband, but sometimes it cracks up. So apologies if it has. There. Alphabet, Meta. I don't mind my pension doing any of this. I wish. Now, let's be absolutely clear. I'm not as good as retail clients, because retail clients know which stock is going to go up, and all their stocks they expect to go up, and they're expecting them to go up a lot. Okay. If I could pick just one stock in hindsight, I would have picked Palantir, obviously. I mean, that's the biggest number I can see on the screen. 400%. I didn't. It's close to an IPO. We don't do close to IPOs because we don't have enough data. And Apple, Amazon didn't do fantastic over the last 12 months. So what? That's why you don't just have one stock. It's why you think portfolios. It's like a team. At times, some will do better than others. They'll make up for the laggards. And then these will catch up. And in 12 months, we'll look back and we'll go, oh, NVIDIA did 0. And these went up. Don't gamble on single stocks. Year to date, that's what it looks like so far. Year to date, Apple 0. Amazon 0. Year to date. Year to date, my Goldman Sachs has outperformed my NVIDIA. Wouldn't have guessed it. Alpesh, you're supposed to be an expert. You should have guessed this. No, I spend most of my time telling people I don't predict as much as people think I predict. Okay. Exchange traded funds. We're just in the process of doing a separate video for exchange traded funds, which I will do. We'll come to some of these. India, we keep an eye on. And thanks to Donald Trump, it's going to go sideways for a bit longer. So still time. That's China. Okay. And this is just over the past month. So there's some names there. Exchange traded funds are a basket of stocks, obviously. And unlike an active fund manager or an investment trust, the costs are a lot lower and they just track an index. So they can be quite good. Mandeep asks, any stocks you'd be open to topping up today? I guess I'd be open to topping up any of my quality 5 plus, Mandeep. I can't remember if you're on the program or not. If you're on the program, any of the quality 5 plus, I'd be fine with opening up. But that's not the issue. Remember, my holding period is long. So even if they fell 10, 20%, I have the data to show that whatever I buy may well drop 25, 30, 40% in the next 6 months. And I'm fine with that because I'm not trying to time that exact 6 months because I'm not trading. If I was trading, which is different, and I sometimes trade, but that's different. I don't even talk about trading on my investment webinars. Okay. Now, past year, this is where we are. The Nasdaq's up 23%. Oh, Alpesh, we've just discovered your secret. You're actually not that clever, are you? You're just sailing in waters which are giving you a tailwind. Mixed metaphors, you know what I mean. Yeah, I got the wind on my back. It just makes me look clever. I'm not. Warren Buffett said the same. He goes, I became the world's richest man because I just happened to be born during a period of the biggest rises in the stock market since the Second World War. I mean, when did he start investing? He's 90 years old. What, 1945? When he was about 12? I've just got the wind on my back. Do you know what the biggest trick is? Avoid panic and boredom. When you've got quality companies, there's 3 stages to making money. By sitting on your backside all day long and doing nothing, which is essentially what investing is. Let's not lie. Okay, I'm of an age where I don't need to big myself up. I've got enough certificates I can stare at all day long to make myself feel good if I need to. God knows I'm not got a 6-pack, so I need to cheer myself about something. There's 3 things that make money. Only one of those 3 is quality companies. You know what the other 2 are? Avoiding panic, avoiding boredom. Once you've got quality companies, I could give people, and I do regularly, every January, a bunch of companies. How come in 2021 people didn't make 60% returns in Microsoft? Because they got panicked when it dropped 10% 3 times during that year, and they got bored when for 9 of those 12 months it delivered 0. That's why they didn't make 60%. Honestly, the biggest problem with investing is getting out of your own way. You're the problem. It's not the market. It's you are the problem. That's why we're very much data-driven with what we do on everything that we do. I'm going to show you some more stocks. Let me just show you the filter. Now, when we filter stocks, none of these meet our criteria. You will know. I need the companies. We take a very data-driven, non-narrative, non-story, non-breathless headline, non-newsletter, gimmicky approach. We take an institutional approach, which is look at the cash flow, the balance sheet, the P&L, and then come up with the value growth of the companies, the cash return on capital invested, the momentum, high sortino, which is high average returns, low downside volatility. And we have a very high rejection rate. Okay. I think it's 95%. I've never done the maths actually. I think it's 95% of companies are rejected. They can't get into my portfolio. They can't get into my son's portfolio. Okay. They can't get into my wife's portfolio. 95% of companies can't get in. Okay. Unless, like I said, they're one of 2 ways. They meet the criteria, or they're what we call the quality 5+, which abide by a similar but simpler rule of stock price movements. Okay. Now, markets can do one of 4 things. What retail clients think is they can only do the first thing, which is go up. No, that's only 1/4 of the time. The other 3/4 of the time, they do things which is what causes you to lose money. 1, they bore you, i.e. they go sideways. Look at that, sideways. You got bored, you exited. 2, they fall, you panic, you exited. Write down, panic and boredom are the 2 enemies of making money. Panic and boredom are the 2 enemies of getting rich in investing. And the other thing they can do is they can, of course, go up and then go down. Again, causes you to both panic and get bored. 3 times out of 4, they're going to make you panic or bored. 1 times out of 4, you're going to be fine. That's why you mess it up, because you get confused, you don't realize what's going on, and you get panic and bored. Price earnings ratios, where are those valuations? This is the US market. It's at a multiple of 32. You're paying $32 for every dollar of profit. Now, here's the good news. I'm going to give you some good news. And I'm going to give you some bad news with the US. Okay, the market capitalization of companies has gone up 18%. The profits of those companies has also gone up 18%. That's good. Profits and share prices have both gone up 18%. If profits had not gone up as much as stock prices, you'd be worried. It'd be nonsense. It'd be like the dot-com era. In the dot-com era, profits going down or loss-making, stock prices going up. That's not what's happening. So that's fine. Are we overvalued? Yeah, historically we are. We're well valued. So wait a minute, if we're well valued, why are you still holding? Because I don't need to panic. When it's time to sell, I'll have a think about it then. Revenues have only got 7%. Now, that is unsustainable. You cannot have sales only 7% and profits going up 18%, because there is a limit to how much cost cutting and profit margin increasing you could do, or how much improvements from productivity you have. That's what leads from revenues turning into increased profits. Okay? Cost cutting, productivity gains, profit margin increases, interrelated. Okay? That can't go on forever. So it's a slight worry, but nothing to worry about too much at the moment. These are the various sectors. I don't care about sectors. I care about companies. Okay, some sectors are more expensive than others, like tech, but that's because the forecasted growth is higher. So you're willing to pay a premium. It's like on Monopoly. You'll pay more for Mayfair than you will for the Old Kent Road. Got it? That's Mayfair. That's the Old Kent Road. Now, Nvidia, Microsoft, Tesla, Alibaba, love it. These are the big movers of the week, apparently. Okay, and over the past year. Amazing. Now, I wrote about Alibaba and AppLovin in December and posted it to the private clients. And so with both, yes, if you're willing to take the volatility, you can get the returns, but you would not just have them in isolation. You'd really want it in a portfolio for obvious reasons. Productivity could well be AI. David, I think it could well be, and it could be that it's permanent. So I take a caveat to what I've said. We might just have 7%. Well, it can't be forever that you can continue doing that, because, but you could have revenues continue to grow far less than profitability, and profitability go through the roof. But I think AI, when I look at the companies and the speed at which they're adopting it, it's not like the internet. The internet, okay, a few benefits, not so sure. The speed at which AI is causing profitability, leading to profitability. I know from our own stuff that we do in the Great Investments Program, it's nuts how much more we can do and how many more people we can reach around the world as a result of some of the AI stuff that we can do. Price to earnings ratio in the UK markets, this is the UK, 90.7, which again, is it overvalued? No, it's historic valuations. Now with the UK, here's what's interesting, 16% rise in profits, earnings and profits means the same thing. Market cap only up 11, so you might as well, it's got more room. But here's the worrying thing, sales are down 2%. That could be due to tariffs, we're not sure. British companies' sales are down, but thankfully profitability is up 16%. Not sustainable. Revenue, market cap is up 11, which means could have more room to go on the upside if we're looking at that. Some of the sectors, you can take a picture of this, okay. Somebody's written CapEx on AI is way too much, won't generate the profits they expect. I'm sure somebody somewhere is doing a return on investment calculation when they do that. Depends on the company. If it's a poorly run company, you're right. If it's a well-managed company, then you're wrong. And how do you find if a company is well run or not? Shall I let you into a secret? Okay, the easiest shortcut I've ever found. It's not what they say. It's not what the board of directors says. It's certainly not what the analysts say. It's not even in their P&L and balance sheet and cash flow. You know the old saying, put your money where your mouth is. The best way I've found to discover, most consistent way I've found, it's not guaranteed, whether a company is well managed or not, is to look at its Sortino ratio, is to look at its stock price performance, that's what the Sortino measures, versus how frequently it falls, the size of the falls, and how quickly it recovers. If it infrequently falls, has small falls, and recovers quickly, it's probably because people are willing to put their money where their mouth is and say, yeah, this is not just a well-run company, but if it does ever fall, we want to put some money into it straight away. Not guaranteed to work, but it's probably more telling than any bullshit that comes out of the board meetings, or certainly any crap that comes out of fund managers' reports or analyst reports who are 3 degrees removed. Follow the money. People tend to be more truthful when you ask them, put your money then there. Talk is cheap. Writing analyst reports is cheap. My wife used to work at Deutsche Bank. Writing analyst reports, cheap as chips. When people put their money somewhere, yeah, it's a pretty good way of telling whether they're telling the truth or not, because otherwise they'd be unlikely to. Poker. They can only bluff for so long before, okay, you call their bluff. So Sortino ratios being relatively high is a good indicator of whether they're well not run. So whether the CapEx and the AI spend, I couldn't care less whether they've got their maths wrong. I'm not a management consultant. What will matter is if they can get consistency of performance. And that's a far better measure. You can take a picture of this. I'm not going to go through all of the ETFs and which ones are doing what. When it comes to ETFs, I don't care what they say on the tin. Europe, World, Japan, China Electric. Those are... If you've ever been to Amsterdam and you've seen the window displays in the red light district, that's what titles on ETFs are like. They're meant to get your attention. Okay, but it's bullshit. Don't go in because of window displays, right? What is actually important is how are they doing? And what's their performance? What's their Sortino? And I'd probably say with exchange traded funds, Sortino is probably far more important than virtually any story or narrative or window display name to try and seduce you into exchanging your money for the ETF. Don't. Exchange traded fund providers are marketing. It's prostitution by any other name. Should be criminal. Okay, they put these lovely little labels on to their ETFs. Awful, because they often don't do anything they say on the tin. I'm still talking about ETFs. Right. FTSE 350 stock rises. I won't go into the UK at the moment. I'll keep that for a separate webinar. That's the NASDAQ, all-time highs. Well, we're still at 1, rising moving averages. Will we get to 2? Yeah, of course we'll get to 2. When? I don't know. But I'll keep doing it. Now, when we get to 2, I've got 2 choices. I.e., when we get to a fall, when we get to a fall, there, see that? I've got 2 choices. Either I can take out an insurance policy, which is exit the market, and with the danger that I might be buying back more expensive later, and the cost difference is my cost of insurance. Or I can stay in which case the danger is I have to sit through a long, prolonged fall. Okay? Got 2 choices. We'll make those when we have to make the choices. Private investors have a desire to make these things too soon. Okay? Patrick's made a good point. AI, what about energy companies? That's a narrative. And the way I try to look at things is like with NVIDIA. I'll give you a great example with NVIDIA. The reason NVIDIA ended up on our radar in 2023, so we were late, is because in 2021 it was on there as well when they were making graphics cards for crypto mining. We didn't know they were making graphics cards for crypto mining. We knew they were generating shed loads of profit. So we care, are they generating the profits? Can they grasp the opportunity, whatever that is? And we didn't know it was AI in 2023. I didn't know at the start of 2023, NVIDIA was involved in AI. I told you, not as clever as you think. You probably think I am at all, but the point is, we knew that they were making profits and had revenues, and they spiked up on our database. We said, okay, let's get them. And then they kept going up like ridiculous amounts. So I thought, I should probably look into what they do. Oh, they make graphics cards which are used in AI. Oh, that's weird, because I've been using NVIDIA graphics cards for about 25 years for my displays. Duh, obviously. I didn't know they were into. I didn't know you could use the same bloody thing for AI. Did you know that? I mean, you probably didn't. I don't care what the narrative is. So, Patrick, what you're actually talking about is taking a gamble and a punt. You've come up with a hypothesis. You've not tested it. Now, mine I've tested. Companies which are undervalued with high returns of growth and good cash return on capital invested and a high Sortino tend to go up more. And momentum. Your hypothesis is different to mine. Yours is AI's come along, maybe energy companies should do well. It's a worthy hypothesis, but it's impossible to test because you've got too little a data set. Whereas my hypothesis has a ton of data set behind it, and therefore it's likely to be more accurate. Now, you might take a punt and a gamble and be right, but that's something different. I don't want to do that with my son's pension. Okay. And that's the way I want you to look at things. I'm not saying you're wrong in what you're saying, but it makes absolute sense. It is, if you're working with me, I'd say, my friend, go out and have fun with that theory. It's not a wrong theory, obviously, on the face of it, but I'd rather see the proof in the pudding turn up in earnings, and I'm willing to wait until it does in said companies. In fact, I don't care what sector a company is for that reason. I mean, the number of times an AI company has, well, Chipotle, you know, Chipotle is an AI company, don't you? You're thinking it's a restaurant chain. Nope. They put AI into their supply chain so they could cut staff costs, reduce waste, improve productivity, efficiency, profit margins. Share price went through the roof. It's an AI company. Great hypothesis, but I only came up with that after the event. I read about this and what we used to do at Bloomberg TV. We'd come up with the hypothesis after the bloody event and the numbers had come out. We could never do it beforehand. Beforehand speculation. There's the FTSE. It's very rare for the FTSE to have an all-time high. To give you an example of what I mean, just a few months ago, it was at 2019 prices. So it's pretty rare for it to have an all-time high. But it's doing it at the moment. Now, time is running short. I do happen to own this, just so you know, and so does my son. I do happen to own this. But the same warning as I said in the S&P applies here. It is a question of not panicking, and this will drop. Now, mark my words, this is going to drop. And the panic people will get out here. People like me will buy more here. Can you see? Chalk and cheese. It's like, I don't know, Middle East conflict. We see things completely opposite. Some will exit there, others will buy there. I'm a buyer. Others are sellers and panickers. And that's fine. What about this? Simple. If it does that pattern, I may, I don't know yet, take out an insurance policy and exit and have to buy back more later because I want to avoid this fall. Your fund manager and IFA won't do that because, first of all, if you go into cash, they're not earning fees. Secondly, because they're not allowed to hold cash. So when this happens, which it inevitably will at some point, and the stock price drops 50%, I'll have taken my insurance policy, gone into cash because that pattern happened, and I'll just wait until we start moving up again, like here. They can't do that. That's why 5 years your pension goes up, the 6th year it collapses, and they mark it for 5 years telling you, hey, look how well we're doing, look how well we're doing. And then in the 6th year, they go, oh, sorry, never mind, keep with us. We'll have those 5 years again. Snakes and ladders. Okay, it's terrible. This is the return histogram for Amazon. Now I'm going to show you something. So this is one of probably the safest by way of return versus risk histograms you'll see of any stock out of 10,000. And we go through all bloody 10,000. And we wish there were companies which in 5 days didn't fall 14%. This is Amazon. It doesn't get better than this. There's probably about 3 other companies which have a better histogram than this in terms of reward to risk. So why do you panic and get bored? This is why you panic. There is a small probability of a big fall. Small probability 1 over P times size of fall equals level of panic. The smaller the probability of a big fall, the more you're likely to panic. So other companies are far worse than that. That's why people panic. And those who showed balls of steel and went to 20 days, oh my God, it's fallen more, Alpesh. And then they went to 50 days. Oh my God. And then they got bored. If the panic doesn't get you, the boredom will. I see the statistics. So I told my clients, let me show you some of the stats at the portfolio level and the individual stock level. And let's put our feet up and go to the beach and have a cappuccino. Relax. Because we can, because we've got the data. History. Not guaranteed in the future, but my God, it'll help. That's what my job is. My job is to get rid of the 95% of companies which don't even meet this. You know what the vast majority of companies look like? Minus 30% in 5 days. Private investors love it. When I come back in my next life, I'm going to be one of 2 things I'll be reincarnated as. Either I hope the bond market or a spread betting firm. Because you add a bit of leverage to this, and I've got a friend, Peter Critis, I've got his book over there. Peter became a billionaire. He told me he was going to be a billionaire, and he became a billionaire through CMC. Because private investors all day long will miscalculate this. Private investors will panic and get bored. If I can stop them panicking and getting bored, I'll do them a massive favor. This is where I am at the moment. Okay, I'm not so risk averse as to wait, and I'm not so risk loving as just to dive into anything and everything. Okay, Microsoft, look, same as the S&P. All of them are looking like this. Okay, Alpesh, which ones are looking like this period here where it's oversold, i.e., if you look at this, okay, that's oversold, that's overbought at the top end, all right? What's looking like this at the moment just before things go up a lot? Next to nothing. Novo Nordisk, not yet. That's it. Nothing is looking like that. Well, doesn't that mean things are about to fall? Yeah, it does mean things are about to fall. Doesn't that mean you should get out now? No, I don't like bloody holding up an umbrella when it's still dry. It's a pain in the arse. Okay. Let's have a look at this. Another one. There you go. The average private investor, particularly on social media, wants to gamble. They want to blow their nuts off with speculating and gambling. I don't know how to put it more politely, but they're absolutely insane. They love it. Hey, have you heard what Suki Alpesh said? You could go get buy, punt into that, punt into this. Yeah, because they're charging you a subscription fee. They want you to gamble. Bloomberg TV, we want you to keep trading because that's what the advertisers want. We need to give you the daily news. Most of it's just completely irrelevant to anything that you're doing. Now, I'm going to, because I've got a call with a prospective client right now. I want you to have a look at this. These are some of the tools we've got. Pension calculator, alpeshpatel.com/links. Okay. We've got a pension calculator. All the links are here. You've got free tools, internships for those who want them. With me as well. Okay, I'm going to see if I've missed anything. I probably almost certainly have missed a load of stuff. I'm just going to check, make sure I haven't. Okay, and for those watching on the webinar, on Webinar Jam, I've got a bunch of documents to share with you, including a free copy of because this is live on TikTok as well, I know. Okay, so I've just sent that to you, and if you're on the webinar and you want to be part of the program, I will also share that with you as well. Okay, so we've got that, and then I'm going to get going, I'm afraid, because that's where we are at as things stand. So thank you for all the TikTokers of being on here. 12 months or Tina is fine by me. Quantum computing, I've done a big report on quantum computing for my clients and mentioned some of the companies that I like and don't like. I'll make it in due course public, probably through an article or so on quantum. I don't mind doing that. By the way, I have do like and follow if you're watching me on TikTok. Any other questions from all the people on here? Jacob, yes, regarding your son and internship, no problem at all, my friend. Sorry, we couldn't meet this morning. I set off straight after the talk, but let's possibly see Monday. Might be able to on Monday, potentially. Thank you, Mukesh and everybody else. I'm going to, as I say, I'm going to go there. For those who want to be part of the program, you know the link. Anyway, it's alpeshpatel.com/shares2, which is the quicker one. So feel free to go there. And any other questions, what I'll do is I'll try and answer these at some point separately, because they're just thousands that have come through. So thank you all for following me on that. And yeah, I guess the one go-to place is just alpeshpatel.com/links for all the free stuff and the free calculators and the tools which have been. Jacob, I know the analogies I go off on one day, they can be a bit weird, I think. I think my wife will kill me with some of those analogies. I've also created, by the way, this is new, AI Alpesh. AI Alpesh is, I've uploaded all my books into it. And you can, whoops, here we go. He says, oh, sorry. You can, on there, ask me anything based on my books, and I've checked the answers. It gives correct answers, which are better than the answers I could have given if you asked me, because I'd be like, well, what did I write about that? I'm sure I wrote something about that. And I did some research on that. Yes, you're right. So it actually does that. So AI Alpesh, and I'm going to turn that into an avatar. So then it can speak back at you as well. So yeah, we've got a ton of stuff, free stuff, if you want to have a look at that. Okay, listen, thanks everybody for your kind patience and your politeness. Although I didn't look at all the TikTok comments. The webinars are always polite. The TikTok can be a bit fruity, should we say, occasionally. But yeah, thank you all for being on. And that, I think, is the end of me. Any emails, let me know. I mean, just email me if you've got any other questions, if I've not had a chance to do these. But yes, once again, thank you all very much. Just got to make sure. There we go. Just end the TikTok first and then end the webinar, I think. So, thank you all once again. I'll just turn that off. There we go. Here I am. Thanks, everyone. Hope you enjoyed it. I better run to my call.